Hello, class, and welcome to our sixth lecture series on international finance. And I'm your instructor, Jamal Haider. Okay, so we were discussing chapter International Financial Markets. But before going to our last lecture where we left that one, we start those concepts. I have included some practice questions. So I want your 100% participation here. So our first practical example is, please find out the real answer. And remember, the practical examples are exactly the exam type question. So this is how I would check your knowledge. So those who are already, taught different subject from me, so they know that how I ask question, I am very much of concept checker rather than give you a question and ask you to write it down in 3 or 4 lines or maybe half a page. So I'm not that kind of instructor. I want to test your concept. So this is how you apply the concept. So we have our first practical example, and that is, assume that a bank's bid rate on Swiss franc is $0.5, 0.45, and its ask rate is 0.47. Its bid ask percentage spread is, please calculate that. Okay, Haley, what is the answer?
Can you give me more second?
Oh, sure. Florian? Cannot hear you, buddy. You should unmute your microphone.
I choose response B.
B. Okay. Okay. Haley, Min?
My answer is A.
A. Kathleen, your answer is A. Okay. Others, please.
I think it's B too.
B.
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 The correct answer is B. So Kathleen, why your answer is A?
I think maybe I used the wrong equation.
What is the formula? Ask minus bid divided by
Ask.
ask, not the bid. Okay.
Yeah,
That's fine.
okay, sorry.
Okay, good. How about this one? So you need to check the right answer. Let me just read that. So dash is not a factor that affects the bid ask spread. What is the answer, Ping Ping? Lota? Dimesh?
I have a question.
Yeah, sure.
I think is A, but I want to, when you say order cost, is like, for example, you're not talking about the shipping fee, is like, the transaction, like to send you the bank transfer, this fee you're talking about, for example, this is the order cost. Like, all of the I will say document.
Documentation and all the stuff is your order cost.
Okay, so it's A.
When you place order, It includes all those stuff. Okay, that's it.
It's D, isn't it? My answer is D, isn't it?
Yeah,
D.
my answer is D as well.
Yeah.
I thought it was D.
I saw because I think it's D. I don't know what. Yeah, just check.
Well,
please.
no. Because volume does affect it, right? Volume affects bid-ask spread.
Volume definitely expect. I think so. Yeah.
Good guys, you are
Hey,
participating. I'm really happy.
Hey,
Good.
what is it?
I'm
So-
really
so
happy that
please-
all of you guys are participating.
So please, can
Ah,
you show
d'accord.
to us the answer?
D.
It's
It's D dog.
The answer is
I think
well
it's
done.
D.
Well done, Fabian. It's D. Kathleen, well done. Why? Because all these factors affect the bid-ask spread. If it depends on the order. If the order is small or big or whatsoever, the order cost. If high order cost, then bid-ask spread is also affecting. Order cost is also affecting the bid-ask spread. Inventory cost. If keeping the currency is very costly for you, bid-ask spread is high. So it means it depends on that one. Volume. If higher volume is traded, like we have many transactions are going on, then bid-ask spread is lower. Low volume, bid-ask spread is higher. So it means volume also affecting the bid-ask spread. So all of these are affecting the bid-ask spread, right? It's not just one. All order cost, inventory cost, volume as well. How about this? True, false? The more intense the competition for traded currency, the larger the bid-ask spread. True, false? So before you spill the beans here, it's true or false. Develop some kind of logic or connection. What do we mean by intense competition, and what does it mean by larger the spread? Larger the spread is good or bad? Just think about in that terms, and then you will realize, okay, it is true or false.
It's false. It's false.
Okay, false. Not. What is your answer?
It's false.
Okay, Nimesh,
False.
Janlab, Marilyn.
I also think it's false.
Well done. It is false. Because if there is more competition, then spread is small. Or the percentage is also small. Well done, guys. Now I'll answer this question. We talked about the forward and future. This is here. Assume a US firm has to pay for Korean imports in 60 days. Right? It expects that Korean won will depreciate. Depreciate means Korean won will decrease in value. But it still wants to hedge its risk. You don't want to get in currency risk. That's it. You want to cover its currency risk. So what type of hedging is more appropriate in this situation? So if these kind of questions come, don't get panic, because what they are asking it. They are worried about what? They are importer or they are exporter. If they are importers, then what are their worries? Now I'm gonna
According to the question, can we have two answer or only one? I see two, because of what he say, but he still want to hedge its risk. So if he want to take the risk, there is a potential one, an option.
It's gonna be
But if
one answer here. That's it.
Okay.
If there is two answers, then there must be some kind of different situation here, but only one answer. So you remember what we talk about purchasing the call or purchasing the put, right? So what do we mean by buy dollar forward? It means you enter into a contract, a forward contract in which you buy the dollars, right? B part, sell dollar forward mean you enter into the contract in which you sell the forward contract, sell the dollar. So if these kind of situations occurs, draw the timeline first. So draw timeline, 60 days. And where are you standing right now? Here, 60 days. And you are in US, right? You have US dollar. Now, you are purchasing from Korea or you are selling to the Korea? You are purchasing, right? It means you will deal in Korean won, right? It means you will convert your US dollar into Korean won, right? So please do not worry about my slow speech because I want to make you understand. I'm going very slow because this is very important concepts, right? So what are your biggest worry? Because you will pay in Korean won after 60 days. What is your biggest worry? That
The value.
after 60 days, what's gonna happen? After 60 days, maybe Korean won will increase. That is your biggest worry. Your biggest worry is that after 60 days, Korean won will increase. When I convert my dollar into Korean won, then I will be having a less Korean won. But the question says, your analysis or your expectations are it will depreciate. But since it's 60 days, anything can happen. Your prediction may go wrong, right? We cannot say that. But they still want to know that what if their prediction is wrong? What should they do? So their biggest worry is not the Korean won is going down. Their biggest worry is what if it appreciates? Because we have planning to buy from $2 billion worth of goods from Korea. And if Korean yuan appreciate, and we will be paying millions of dollars in extra to convert in Korean dong. So we want to eliminate that risk. We don't want to do that risk. Even though our our analyst or our predictions are that the won will depreciate and we will be benefited, but we are not going into that one because if it appreciate, then we will be at much loss or at much risk. So we don't want to take that risk. So that's why what they want to do. Guys,
If I would like to make a call option C.
they want to purchase what? Purchase call option. So they want to purchase dollar. They already have dollar. You are in US, your currency is dollar. If you purchase call option on dollar, it means after 60 days you will purchase dollar. Your worry,
No.
your worry
Put
is
option.
your worry is Korean won, not the dollar.
So put option.
Put option is sell dollar. I will sell you dollar at that price after 60 days, and I have the option as well.
So one is sell and one is buy dollar. That's what you mean? Oh.
Florian, now I understand. Good. It can be two answers. I didn't read down the all the options here. Okay, it's good. It's good. So,
Like, can you explain like what happened for sell dollars and buy dollars, like the option?
forward is a contract, right, Fabian?
Yes.
So both parties cannot